Hello, everyone, and welcome back to the Commodities Institute podcast. I am your host, Emily Costa. It is Tuesday, March 10th, 2026. And if you've been watching the screens today, you know that the word of the day is volatility. Today, we're going to untangle the web of news coming out of the metals markets, the power sector, agriculture, and of course, the high-stakes situation in the Middle East that is sending ripples through the oil and freight lanes. Let us start our journey today in the world of metals, where China continues to defy some of the more pessimistic economic forecasts. We have seen fresh data showing that China's iron ore imports for the first 2 months of 2026 have climbed 10% compared to a year ago. That brings the total to 210.02 million metric tons. It is a massive figure that highlights both a surge in supply from Australia, which saw fewer weather disruptions this year, and a resilient level of domestic demand. Interestingly, while the iron ore is flowing in, the steel is not flowing out at the same rate. Steel exports actually slid by 8.1% to 15.59 million tons, largely due to new export license requirements aimed at cooling down international trade friction. While we are on the subject of metals, we have to look at the brewing tension in Mongolia. The government there is currently in a high-stakes standoff with the mining giant Rio Tinto over the Oyu Tolgoi copper mine. Prime Minister Gomboja Zandanchata has been very vocal, calling the current commercial terms unfair, even suggesting that the Mongolian people have been deceived. The crux of the issue is a multi-billion-dollar loan that Mongolia took from Rio Tinto to fund its share of the mine's development. That loan currently carries a floating interest rate of over 11%. The government wants that slashed to less than 6% and is pushing for a reduction in management fees. With the mine expected to produce 500,000 metric tons of copper annually at peak production, the stakes for both the Mongolian economy and Rio Tinto's growth profile could not be higher. Moving from the ground to the grid, the power and carbon sectors are grappling with a massive dislocation in liquefied natural gas markets. Because of the effective closure of the Strait of Hormuz, nearly 20% of the world's supply of this super-chilled fuel, primarily from Qatar, has been cut off. This has sent spot prices for liquefied natural gas in North Asia soaring by 116% in just a week, reaching $22.50 per million British thermal units. This spike has reopened the window for something we call gas-to-coal switching. In countries like Japan and South Korea, utilities are finding it more economical to burn high-quality thermal coal rather than record-priced gas. We are seeing Australian thermal coal prices hit a 14-month high of $129.62 a metric ton as a result. Even in Europe, where coal capacity has been systematically retired over the last 2 decades, there is a renewed scramble for South African coal as a bridge through this energy crisis. However, it is not all gloom in the gas sector. In the United States, the developer Venture Global LNG is attempting to project a sense of stability. They have reached out to major customers like Shell and Orlen to promise that their Plaquemines export plant in Louisiana remains on track for long-term deliveries starting October 31st. This is a bold commitment given that benchmark gas prices in Europe are currently trading at 3-year highs of around $21 per million British thermal units. Venture Global is clearly trying to move past previous legal disputes over delayed cargoes and position itself as a reliable alternative while the Middle East is in turmoil. Now, let us turn our gaze toward the fields and the agricultural markets, which are feeling the heat from both seasonal shifts and energy costs. In Malaysia, palm oil stocks have plummeted to a 4-month low of 2.70 million metric tons. We saw production drop by 18.6% in February, and while exports also slowed, they were not enough to offset the dip in output. Across the border, Indonesia is raising its export levy to 12.5% to fund its biodiesel mandates, making Malaysian supplies a bit more attractive by comparison. But the real story in agriculture might be what is happening in Brazil. As global energy prices surge, Brazilian sugarcane mills are making a strategic pivot. Analysts expect these mills to shift more of their cane toward ethanol production rather than sugar. When fossil fuels become expensive, the returns on biofuel look a lot better. This could lead to a tighter global sugar market, especially since Brazil is the world's largest producer. Interestingly, the Brazilian state-controlled oil company Petrobras has not yet raised local gasoline prices, likely due to political pressure ahead of the October elections, but market experts suggest those prices are currently 46% below where they should be based on international parity. This brings us to the heart of the storm, the oil markets and the deepening conflict between Iran, the United States, and Israel. The rhetoric has reached a fever pitch. Iran's Revolutionary Guards have declared that if attacks on their soil continue, they will not allow a single litre of oil to be shipped from the Middle East. President Donald Trump has responded with a stark warning, stating that the United States would hit Iran 20 times harder if blocked the Strait of Hormuz. We are seeing a tragic human cost as well, with reports indicating that at least 1,332 Iranian civilians have been killed since the air campaign began in late February. The appointment of Mujtaba Khamenei as Iran's new supreme leader suggests a hardening of resolve in Tehran, which initially sent oil markets surging by 29% on Monday. However, we saw a sharp 10% retreat on Tuesday after Trump expressed confidence in a swift end to the war and hinted at easing sanctions on Russian oil to help fill the supply gap. Finally, we have to look at how this is physically moving or not moving across the oceans. The dry freight sector is seeing a massive redirection of trade. Because the Strait of Hormuz is essentially a no-go zone, ships carrying bauxite and alumina destined for the Middle East are literally turning around. We are tracking vessels like the Richmond and the Glory Energy that were supposed to deliver raw materials to aluminum smelters in the United Arab Emirates and Bahrain. Instead, they are veering east toward India and China. Considering the Middle East accounts for 9% of the global aluminum supply, these disruptions are not just a shipping headache. They are a threat to the global supply chain for everything from soda cans to aircraft parts. It is a stark reminder of how interconnected our world is. A conflict in one corner of the globe can change the destination of a ship thousands of miles away in the middle of the Indian Ocean. As we wrap up today's episode, it is clear that we are in a period of profound transition. From the renegotiation of mining debts in Mongolia to the shifting energy mix in Asia and the rerouting of the global merchant fleet, the commodities world is operating in survival mode. The coming weeks will be critical as we see if the predicted swift end to hostilities in the Middle East materializes, or if we are settling into a long-term period of high prices and restricted supply. Thank you for spending your time with me today. If you found this episode valuable, be sure to subscribe, share, and leave a review.